There are some mixed signals seen in Metro Chicago's multifamily market performance. We'll talk about what we like in the stats and what we don't on this edition of Apartment Market Dynamics from MPF Research. I'm Greg Willett. Cameron McIntosh is here as well. Cameron, Chicago is a spot where the demand is really seasonal. You've got to pick up those new residents during second and third quarters because they're not going to show up in the Midwest's cold weather months. So how did the demand numbers look as we went through this peak leasing season?
Combining the second quarter and third quarter demand tallies, 8,740 units were absorbed in that peak leasing period. That's a very solid showing, just a hair off the demand totaling about 9,200 units recorded during the 6 months of peak leasing in both 2015 and 2014. With that demand topping completions, we're ending third quarter with occupancy at 96.6%, the highest rate seen in the Metro Chicago since the middle of 2007.
Those are some really encouraging results, but we started this discussion saying that there were mixed signals in this metro. Here's what's not great. The solid demand and healthy occupancy seen of late hasn't come with any real pricing power. Effective rents for new leases are up at a mediocre pace of 2.2% over the past year. Class B units are doing best. Pricing is up at a pretty solid pace of 3.4%, but rents are up slightly over 1% in Class A product and a bit under the 1% mark in the Class C units.
Chicago isn't adding new supply at the pace we're seeing across most Sun Belt markets. But by local standards, there's a lot of ongoing building in process. Ongoing construction is at 18,177 units, representing 2.6% inventory growth over the near term. Assuming product can get across the finish line reasonably close to the targeted timetables, Chicago will be adding apartments at annual levels of 9,000 to 10,000 units. That's up meaningfully from the completion pace of 5,000 to 6,000 units maintained over the past 3 to 4 years.
A 62% share of Chicago's ongoing construction is found in the three most urban submarkets. Those are the Loop, Streeterville, River North, and Lincoln Park, Lakeview. While no individual suburban submarkets have particularly aggressive building in process, just the fact that any new product at all is on the way is an upturn in activity for most of those spots.
With substantial new supply about to finish, it shouldn't surprise you that we think Chicago's occupancy is going to soften a little. We're looking for a decline of close to 100 basis points over the coming year. The resulting rate is still good, however, given today's occupancy level is near an all-time high.
Forecast rent growth in Metro Chicago goes to roughly 3 to 3.5%, a little better than today's result. For that performance to be realized, the urban submarkets are going to have to achieve a bump in pricing power. That forecast could prove to be a stretch given how much new supply will be moving through initial lease up in those neighborhoods, particularly the Streeterville zone. I feel like there's some vulnerability that the Metro might not live up to this baseline forecast.
It looks like we could continue to expect some mixed signals out of this Metro. That's going to wrap up our look at this sort of good but also sort of bad story for Chicago. I'm Cameron McIntosh and he's Greg Willett. Thanks for watching Apartment Market Dynamics from MPF Research.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.